Imagine your financial future as a majestic oak tree. Now imagine watering it with soda, chopping off branches for firewood, or planting it in a desert. Sounds ridiculous, right? Yet countless aspiring investors unknowingly do the same thing with their money trees. Today, we're uncovering the 10 biggest investing mistakes to avoid. Stick around because mistake number 10 could save your entire portfolio from disaster. I'll also tell you how to avoid every one of them. Hey everyone, welcome back to the Infinite Income Channel. I'm George Mayfield, aka the Dividend Doctor. Have you ever felt like investing is this secret society with its own language, or like you're just guessing your way through? You're not alone. Most people dive in without a guide, and that's exactly when costly mistakes happen. So here we go. Mistake number 1 is a big one: not having a clear investment plan. Not having a plan is like driving without a GPS. You're just wasting gas, burning money without knowing where you're headed. Do you want to buy a house in 10 years? Retire comfortably? Build a fund for your kids' education? Your goals determine your investment strategy. Without a plan, you're just driving in circles, burning gas and money. Set specific time frames and dollar targets, then reverse engineer your investing strategy. Mistake number 2 is trying to time the market. This is like trying to guess exactly when a bouncing ball will hit the floor so you can catch it at its lowest point, and then guessing when it will reach its highest point to sell it. Sounds impossible, right? Because it pretty much is. Even the smartest financial wizards can't consistently predict the exact ups and downs of the stock market. Instead of trying to time the market, just focus on investing regularly over time, no matter what the market is doing. This is called dollar-cost averaging, and it's your secret weapon against market timing. Mistake number 3 is ignoring diversification. Think of your investment portfolio like a picnic basket. If you put all your eggs in one basket, and that basket falls, you've got a scrambled mess. But if you spread your eggs across several baskets, even if one basket tips over, you still have plenty left. Diversification means spreading your investments across different types of assets, like stocks from different companies and different sectors, bonds, and even real estate. That way, if one investment performs poorly, others can pick up the slack. ETFs, exchange-traded funds, or index funds can automate the diversification for you. Some funds hold hundreds of stocks. Diversification doesn't get any easier than that. Our 4th mistake is a common trap: investing based on hype. Chasing hype is how people bought at the top of meme stocks or crypto trends and lost big. Investing in something just because everyone's talking about it, or because you saw it on social media, is incredibly risky. These hype investments often crash and burn, leaving investors with empty pockets. Stick to investments you understand and believe in long term. Do your research and understand what you're investing in. Don't get swept away by the latest shiny object. Slow and steady wins the race, especially in investing. Mistake 5 is panic selling during market drops. Markets dip, it's natural. But panic selling turns a paper loss into a permanent one. Imagine you're on a roller coaster. It goes up, it goes down, it goes up again. You wouldn't jump off just because it's going down, right? The stock market is like that. It has its ups and downs. When the market drops, it's easy to get scared and sell everything. But often those drops are temporary, and the market recovers. Use volatility as a buying opportunity. Selling in a panic means you're locking in your losses and missing out on the eventual recovery. Remember, investing is a long game. Ride out the bumps. Mistake 6 is neglecting fees and taxes. A 1% fee doesn't sound like much until it eats up thousands over time. Fees can eat away at your returns without you even noticing. Every investment, whether it's a mutual fund or a brokerage account, comes with some fees. And when you make money on your investments, you'll likely owe taxes too. Choose low-cost ETFs or index funds. Use tax-advantaged accounts like Roth IRAs or HSAs to minimize tax drag. Always read the fine print, understand what fees you're paying, and be mindful of the tax implications of your investment decisions. Every dollar saved on fees is $1 more in your pocket. Mistake 7 is not reinvesting your dividends. Dividends can quietly double or triple your portfolio's value over decades if reinvested. Some stocks pay out a portion of their profits to shareholders called dividends. Think of it like a tiny bonus. Instead of taking that bonus out, you can choose to use it to buy more shares of the same stock. This is called reinvesting dividends, and it's like a superpower for your money. It creates a compounding effect, where your earnings earn more earnings, making your money grow faster over time. It's like a small snowball rolling down a hill, gathering more snow and getting bigger and bigger. Use DRIP, a dividend reinvestment plan, to auto-reinvest and let the compounding do the heavy lifting. And now our eighth mistake is ignoring inflation. If your money isn't growing, it's shrinking, thanks to inflation. Have you ever noticed how the price of your favorite candy bar or video game seems to go up every few years? That's inflation at work. It's the slow, steady rise in prices over time, which means your money buys less in the future than it does today. If you just keep your money under your mattress, inflation will silently eat away at its value. Invest in assets with a history of outpacing inflation. Investing helps your money grow faster than inflation, so your purchasing power actually increases over time. It's how you make sure your future self can still afford that candy bar. Cash is not king long-term. Mistake number 9 is not regularly reviewing your portfolio. A good investment can become a bad one if you're not paying attention. Imagine your investment portfolio is a garden. You wouldn't just plant seeds and then forget about it, right? You need to water it, weed it, and sometimes even prune it. Schedule a portfolio checkup every 6 to 12 months. Rebalance, reevaluate goals, and cut underperformers if needed. Are they still aligned with your goals? Are there any underperforming assets you should consider selling? Are you still diversified? A quick checkup can ensure your financial garden stays healthy and continues to blossom. And here is a big one. Mistake number 10 is investing money you can't afford to lose. If you're investing your rent money, you're gambling, not investing. Investing always carries some risk. It's like going on an adventure. There are always some unknowns. That's why you should never invest money you need for essential things like your groceries, fuel, or your mortgage. Before you even think about investing, make sure you have a solid emergency fund, money saved for unexpected expenses that can cover at least 3 to 6 months of living costs. Only then should you start thinking about putting money into the market. This is your financial safety net. Now let's recap what we've talked about. Number 1, not having a clear investment plan. Number 2, trying to time the market. Number 3, ignoring diversification. Number 4, investing based on hype. Number 5, panic selling during market downturns. Number 6, neglecting fees and taxes. Number 7, not reinvesting your dividends. Number 8, ignoring inflation. Number 9, not reviewing your portfolio regularly. And number 10, risking money you can't afford to lose. Avoiding just a few of these can put you far ahead of most investors. Just a quick note here. I am not a certified financial planner, investment advisor, or legal professional, but I've been doing this a long time. The information provided in this video is for educational and informational purposes only and should not be considered financial advice. Now, if you've gotten value from today's video, please take a moment to like and subscribe to our channel. And if you'd like some real-world examples, check out our video 3 Dividend Stocks Set to Explode in 2025. Thank you so much for watching. I hope this video empowers you to make smarter, more confident investment decisions. I'm George Mayfield, the Dividend Doctor, reminding you to invest wisely and keep building your infinite income.